Now, everybody, it's Tim Reazor with Revere Asset Management. Just about 3:30 here on a Wednesday night. So very quickly, stock nerds, market lovers. Before we begin, look, today is just ridiculous. I mean, up here this morning, I'm going to not use the S&P. Well, I can do the S&P futures here. Let's do S&P futures. I'm going to just do SPX because that's where I want to focus today. But S&P futures all the way up here this morning, overnight at 40. What levels at 40.50? I mean, you went down 40.50 all the way down more than 100 points, 39.23. And then if you go SPX since last week, you're down over almost 400 points. So let's talk. And I think the question we need to ask ourselves here, and I'm going to lay out a case here, and I'm going to let you decide: are we about to crash? And you're like, haven't we already crashed, Tim? And I'm going to tell you that we haven't. We have not already crashed. This has been a systematic walk down. This has not been the whoosh violent crash that I believe that we need to see to cleanse the palate of the market. Every now and then we get a little reprieve, the heartburn goes away, but you know, it's kind of like you keep taking, like, for those of you that have ever had heartburn, consistent heartburn, you know, you take the Rolaids, but the underlying issue is still there. And Rolaids are just a Band-Aid. Markets had a couple Band-Aid bounces. Band-Aid bounces don't really work too much. And we just keep systematically, that's the key word there, systematically, mechanically walking this down. And we're not whooshing. We need to whoosh. We are, another analogy, we're at the party. We've had a little too much to drink. And the only way to feel a little bit better isn't by drinking coffee or just sitting still or drinking some water. It's going to have to throw up. And you're like, I don't want to throw up. It hurts, right? But that's kind of what the market needs to do here. And so I want to go over all of that with you, because what's really interesting here is that the readings that the market's given off of complacency. And you're like, who can be complacent in this market? Tim, haven't you been reading crypto is crashing? I've read all the crypto is crashing type stuff, right? I know what's going on with Luna and UST and all that other stuff, and Bitcoin and Ethereum, and that's what happens, man. That's what happens in markets like this, but the market is still, believe it or not, a little bit complacent, and I want to take a look at that with you, okay? So real quickly though, but before we begin our sojourn, and I lay this out, and by the way, I'm going to end the video with a watch list. You're like, Tim, but you just said, are we about to crash? And you're going to lay out this thing that, hey, yeah, a crash could still be coming, because remember, folks, it can always be worse. And I'm going to tell you something about it's never too late. I want to talk about that as well. But before we do all of that, listen, stock nerds, if you ever wanted to see our work in action here at Pass at a long-term level, it's just revereasset.com. And if you go to tomorrow's insights, you can watch every video from every market environment, including this one, to see how we've been handling it, how we've limited drawdowns, all how we we went to 100% cash. I think we ended that last week. Bought a couple, sold a little as it didn't work out, and just how we've been managing everything. Okay, and you can see all that. And then listen, if you don't like my tone, you don't like what I'm saying because it's not what you want to hear, and you're like, I don't like the glib of his chin. I don't think that's the same, but you get what I'm saying. You can always email me. You can always tell me I'm wrong. You can always debate me. You can always talk to me. Tim@revereasset.com. TJ Reazor is how you get a hold of me. There's Don. If you want to see the folks that make the decisions in the portfolios, Don Vandervoort and Hunter Mazingo, there he is as he pops up on the screen. They make all the decisions, the buys, the sells, and what goes on the watch list. And whether you're a client or not, and you just want to talk to them, they're always available to you. It's what separates us from every strip mall advisor next to the vape shop, right? Like, it doesn't matter if you're with Yale Hutton or Merrill Jones, you can always talk to us, and it's never plausible liability. It's the people that actually make the decisions and the strategies for the portfolios. And then if you want to talk to America's Fiduciary here, Danny Stewart, okay, you can do that, or just call us at 855 Real Wealth. But the bottom line is, if you don't let, it's easy for me to say, right, because I'm not you, but don't let the markets get you to the point where you're not, I don't know how else to say it, but you're not functioning, or you're just angry. Because if you're there, call us, please. We're not selling you anything. It just helps to have someone to talk to. And which then leads me into my next point. You know, it's not cavalier when I say, are we about to crash? I do believe markets can go lower. Let me show you something. And I saw a really disturbing email, and perhaps we'll talk about it on the podcast this week, from a broker. Someone had sent to us, and it's disturbing, because it was a stay the course email, and the cavalierness and the cavalier way. The person said, hey, ETFs that you're in aren't as volatile. And I'm like, really, dude? The ETFs aren't as volatile? And you're like, well, what about the, you know, the ETFs aren't as volatile? Like, I mean, give me a break. Look at SPX, and all the variables that go in there, all the ETFs off of SPX. Here's SPX on a daily chart. SPX, the average true range, my friends, is 110 points on a 3,900 now on a $4,000 product. That's not, is that not volatile? What do you think the chip ETFs are like right now? Like, it's all volatile. That's the point. Like, the person completely missed the point. And so, and his words were, I'm summarizing, maybe we will get into it on the podcast this week with Danny and Don and Hunter. Maybe we will delve into this person's email, but the broker is saying, just stay the course. You wrote it down this long, just stay the course. And my friends, let me show you SPX on a monthly chart. And I brought you this work before. Hold on a second. And I brought you this work before. Markets typically want to retrace and give back 50% of their moves, no matter the time frame, whether it's a 5-minute, 30-minute, hourly, 4-hour, daily, weekly, or now in this case, monthly chart. It's just all, when does it get there? When does it happen? 50% of the move is right here at 3,500. And I've told you this before, the fib levels are just like cattle fences, they herd. So when 786 gives way, 618 your next test. Yeah, if you know, maybe we bounce a little bit and then we come down. But right now, this is the fence. This is the two fences you're working in: 786, 4256. I mean, this is so violent. It's so incredibly violent. And for someone to say stay the course, well, what does staying the course get you? And I want to talk, what are you hoping for by staying the course? And my look, I'm not a cynical person, and I'm certainly not, you know, I don't do sarcasm also. I'm not being that way with you when I say, what does that get you? So let me show you this. Let me show you this tweet right here from somebody that I saw on Twitter the other night. This is from last night, 6 months return. So let's say you're in these stocks. I'm not in these stocks. Okay, you're not in these stocks. Maybe the ETFs are in these stocks. Well, MasterCard's not that bad. But like, what are you hoping to get? Do you think the Shopify you're in is going to go up, you know, like another 77% this year? Next year, well, I'm a long-term investor. Okay. 77% from when? You're not going to, Upstart, 88%. You're not going to see these stocks reach out. This doesn't even include all the big ones, right? Netflix and all the others. You're not going to see these stocks go up again and touch their highs until they inject the markets with another round of stimulus or quantitative easing. So now think about that. If Coinbase, right, which is 70, and it's down again today, 78% off of its highs, or Affirm, right? Robinhood down almost, probably, it's all more today. Down 73% as of last night off its highs. What do you think is going to get Robinhood to go up 73%? It's going to be Monty printing. It's going to be stimulus. And human nature being human nature, if they do that, Do you think the population that's getting stimulus, getting that money that's being printed, you think they're going to go out and buy Shell oil, or are they going to go buy all the beaten down names because everybody loves a bargain, right? And so that's what makes this incredibly tough, that you have still a tremendous amount of room to go down. If there is no Fed put, you have a tremendous amount of room to still go lower. Staying the course. I mean, geez, Louise. And you're like, well, Tim, how much are we down here? This is S&P's, the conservative index, shall we? Okay, so here we are. We're down almost 18.5% from the high. Not quite bear market territory. If we go down to the 618 here at 3,800, we'll be 20% bear market territory. Kind of makes sense. If we exceed that level down to the 3,500 level, I think we're heading to, you're going to be down 27%. Can it get, it can always get worse. Well, what if we, and what happens is you get into this purgatory of the market where you're just bouncing in between a little bit. And for me, I just want to get it over with. Throw the hell up. Get rid of all the nonsense and let's build a base. Let's get the cinder blocks out. Let's get the cement. Let's clean out the hole. We knock down the house and let's build ourselves a foundation to which to build upon. I mean, look at the NDX, the NASDAQ 100. So here we are. Right now, we are currently almost 30% off the highs. Now, maybe we find some support here. That would make sense. We're on a monthly chart, folks. We're going back to 2020 levels right now, right? August of 2020, that support zone right in here. But what if we do exceed that? What if we break this support and we just come down to the monthly 200, you know, to, the monthly 40-month period, pardon me, you're down 36%. And the market hasn't capitulated yet. And you're going to tell me, Tim, how can you tell me the market hasn't capitulated yet? And let me show you. So let's look at the VIX. So today the NDX was down another 3%, and the VIX was down 1.3%. Not up, down. How's that cash VIX working for you? The one that they all talk about. The VIX is too high, the VIX is too low. They don't know, nobody knows how to use it. And so I bring to you what I think really matters. The VIX futures. They were inverted. Early last week, the Fed comes out, the inversion goes away. You have that great rally on Wednesday afternoon, lasts all of 2 hours, 3 hours, and it rolls over Thursday. Friday, they invert. And what did the markets do since Friday? Here, let's get on a daily chart. How far did the markets fall from when the VIX inverted on Friday? So here is a daily chart. So here's Wednesday, Tuesday, Monday, here is Friday. Like, and I want you to think about them and look at this on a daily chart. It can't go any lower. It's already down so much. And here we are. Here's Friday, and we close down. We're down another almost 5 3/4, 6%. This is not meant to scare you. What this is meant to do is just tell you that, hey, if you're saying stay the course, well, tell me what course you're staying for. What is your plan by staying? What is in your portfolio right now? Retirement account, 401k. What is in there worth staying for? And if you don't have a solid answer, or you can't get a solid answer, perhaps maybe it's time to trim and wait. Cash is winning right now. I mean, inflation's taking a big stab at that, but I mean, I don't think inflation took 6% this week, right? And speaking of inflation, right? Like if we come here, what has happened this week or this year or since last year? Look at this, gas, 44%. Airline tech. Look at all of this. This is how you get a market that's down almost 1,000 points from the high and not done. The last part's my opinion. But I mean, eggs seem like a bargain, only down 10%. But the market still has a lot of room to correct. And you're like, well, Tim, what if the NDX? What if now look, what if the NDX? Here's the COVID lows, right? So here's where the breakout is. So I'm just going to draw this, okay? So we're gonna take the marker, the high here. Well, let's do it from here. How much further, if we give it all back, right? Like the market was so inflated that it gives it all back to like this pink line, like this price area here. It's down another 22% from here. That's nutso, right? That you could go down another 20% SPX. And so I'm not saying that's what's going to happen, but what's going to stop it? What is the Fed going to do that's going to stop inflation? What is the Fed policy going to do? It's going to create demand destruction. That's the only thing the Fed can do. If we drew a straight line and like, well, how much further down to this level right here? It's another 15% on the S&Ps. So if you're of the place in life that another 15-20% doesn't matter, okay, and you're going to stay the course, great. But what is it really all about? In my opinion, it is about this. It's about working from where? A higher base. So let me explain. Higher base. Let me just drill this into you, because what a lot of folks will say is that you can't time the market. You can't. You're going to miss some of the biggest updays. You're only missing some of the biggest updays because you missed some of the biggest down days. This rationale that you have to participate in every market day, there's 252 of them a year on average, and that you have to participate in every one of them is bullshit. It's not true. Some of you out there I know would love to have been in cash. And so when you go to cash and you cauterize the wound, you stop the bleeding. And that when the market finally does turn in your favor, and they don't send you a memo. March of 2009, they don't send you a memo, right? March of 2020, they don't send you a memo. But when it does turn, you can capture all that in some. But if you're starting with 30% less because you didn't go to cash, 25% less because you didn't go to cash, imagine over the course of your investing lifestyle, not going to cash, not being conservative, not winding down laggard positions, taking a head in the sand mentality that you ride it out, it always works out. Well, the market doesn't go in your time frame. What if you're going to retire this year, next year, the following year? How many years did this just take off of your estimated savings that it would last that long? And so the cavalierness from the broker that wrote to someone that had forwarded us the letter is disgusting. And we probably should on the podcast discuss it. Let me show you where, if you don't get the podcast, you can get it free. Of course, I don't charge for it. We don't charge for this. We give away everything we're doing, knowing that our business model is to share everything that we're seeing, tell you the strategies to which we're employing. And if we're able to help you and empower individual investors, that's what we're going to do. But knowing that it's your parents and your loved ones, because we've built a rapport with you and trust that you'll send to us if it's not yourself. And so look, you go to Tomorrow's Insights, and if anybody wants to see our work, you just scroll down. We've been doing videos since March 2014, and it was me just doing them at first, and then Don, I think, came along in 2015, 2016 maybe, and then he started doing videos. But you can see how we handled every market condition. Want to see the podcast? Just click the podcast. And this last episode was really good. Don't let the titles get you, right? We're just trying to have a little bit of fun. But the content discussed is absolutely, for the people that listen, we know it because they write to us, is life changing. And so for that, we're grateful that people do tune in. And then look, if you want to get a hold of us, here's our contact information. I've got a little bit more to cover with you. There's the portfolios. You just click on hybrid and you can see the different ones. You can contact us, 855 Real Wealth. If you want to just, if you don't want to send an email, you just want to send a nondescript contact, just go to the contact page and we will get back to you. And then you can always come to the office and visit if you want. So if you want to subscribe to the to our content, we send an email out one day. We never contact you. We don't have a sales funnel, so don't ever worry about that. We're not like every other business in the free world. And then real quickly, if you want to get a hold of me, Twitter, I guess someone's already done it. Have a message right here. So it's like we're texting buddies. So at TJ Reazor is my Twitter handle. It's the quickest way to get a hold of me. My inbox jams up. Twitter is very, very accessible. My DMs are open. You just shoot me a quick message and I get back to you. And it's also, you can send me topics too. I like it when people send me topics for the show on there. People have been doing that of late and I really enjoy that. So let's take a look here. So I said the market's complacent, the VIX is down. Let's continue to build upon that theme. So look here, the put call ratio. Markets are at their lows, right? You can see that there's an S&P chart on the bottom here. And the put call ratio is not at its highs. I mean, here back in February, put call ratio spikes, and then we start trying to make another move, put call ratio spikes, and you put in a little short-term bottom there. This is complacency. I don't know if people are in shock or puts are still quote unquote cheap, but right now this is not extreme fear. And that's the problem. We haven't capitulated yet. So when I say, are the markets about to crash? I mean, the VIX is not spiked. The put call ratio is not spiked. The things that I look for, the VIX is inverted. The VIX futures is inverted. And I've explained ad nauseum what that means. And if you don't understand what that means because you're new to our work, just shoot a note. Call 855 Real Wealth, or Dan at Revere Asset, or Tim at Revere Asset, Don at Revere Asset. It's a big deal that you understand all this stuff. And so that further builds my picture as to what's going on here. And then I'm going to go back to a monthly chart here before I give you this quote unquote watch list to look at. Dixie. Now we've been talking about this. This needs to relent. This market here, let me show you. So over a 5-minute chart, the market's still following the dollar. So the dollar spikes this morning at 7.55 and it bottoms at 8.45. So as the dollar's coming down, 7.50, the market, now keep in mind the market opens at 8.30. What are futures doing in here? Okay, so we'll put it on SPY. We'll put it on ES and we'll try to get it here. So 8 o'clock. What did the market do? 7:45 up until 8. Yeah, the market started to recover. So you had this big drop from the CPI report, high again, shocker, and apparently not transitory. And then you've got the markets recovering. The dollar is king here. Okay, you need the dollar to break lower, and it's not. And when the dollar bottoms, the markets just fall apart. And so where are we in time and space? Because your situational awareness is crucial here. I think we're going to 108, 110 in the dollar. I think we're going up to challenge this level over here. And if we do that, that's probably when you finally get some form, some modicum of capitulation. But on a monthly chart, we're ready to break out. Doesn't mean we won't come back and test, but this is, if we come back and test, you'll see a reprieve in the markets. Equity prices will go higher, but this dollar is a problem. It needs to come down. And there's no Fed tool other than killing demand, killing consumer appetite for spending that does that. That's what loosens up supply chains, right? Because there's no demand for products. And if you want more on that topic, you want more about demand destruction, go to Tomorrow's Insights. I encourage you to click the podcast tab and right here, click watch video. You can get it on your iTunes store, Google Play Store, and you can see exactly, Tim, what has to do with how the markets are moving. Remember, markets move because they have to, not because they want to. These markets move because they have to. People are losing money in other facets of the market and they're selling equities. So this is the other argument you'll hear right now too. Robinhood's the future. Everybody's trading on it. Let's see here, Coinbase. It's crypto. It's the future, right? These companies aren't going away. Let's hold that breath there. But you know, these stocks are moving not because they're bad. They might be bad companies. Who the hell knows? But because people are dumping them because they're losing money or trying to raise cash because of other things. Markets move because they have to, not, my friends, because they want to. And it's really important to me that you understand this. So real quick. So I got this list. This is actually a user submitted list from a dear friend, and moving average stack weekly scan. So let's do this. I'm going to get this to a weekly, not a monthly. And I've got it color coded to match up. Let's find the chart here. Go put it over here. Let's just run through a couple of these and see. Good. Look at AA. And you're like, Tim, how was that on this moving average stack weekly? So yeah, there's the 5 is above the 21, above the 34, above the 50, but it's not support the 10 week, excuse me. You know, these stocks, they all get hit. Some better than others, but they all eventually get hit. And you don't have to be in the game. And some of you are like, well, Tim, I have to be in the game. I have to be 100% invested because that's what my 401k dictates. There's got to be some kind of cash. They have to offer you some kind of cash equivalent, right? And what happens is FOMO sets in, and when you have these big spiky up days and you feel like you're missing out, it's human nature. I don't begrudge you for it. I get it too. I'm human. I'm not a robot. And so they don't ring a bell when the coast is clear, but I'm going to leave you with this. And I don't think it does you any good for me to run through this list. If you want this list, you're more than happy to have it. Email me, tim@revereasset.com. I'm more than happy to send it to you. Let's look real quick. We're on a weekly chart here. Let's look at SPX from when the market bottomed here. What were some signals that you could use to time? And I'm going to keep it extremely simple. Let's do two on a weekly chart, right? So we won't even use daily. We're just going to use weekly, but you can take this to a daily. How about a 5-period crossing the 8? And you're wrong if that 5-period crosses below the 8. Doesn't really, well, maybe it does cross below there, but when does the purple line's the 5, the green dotted line's the 8? If you look at my chart, the 5 this whole time almost right doesn't, no, not there, not there. Maybe here back in October of last year does it cross below the 8, but it crosses right back above, so you're in 5 exponential moving average crossing above the 8. Do it again for you. So, or you could do a 521. Like here, we'll do 521. Now my purple line is the 5, my pink line is the 21. And you get a cross here at S&P 2944. And only here at S&P, was that 4,500? Did you get a cross below? 8 below the 21. Or 5, excuse me, 5 below the 21 is up a little bit above, pardon me. There's a number of ways to do this, and they don't require you to sit in front of CNBC, Bloomberg, Yahoo News, whatever, and listen to pundits. And price will lead you in the direction you need to travel. You just have to believe what you're seeing. And this is why I was a pilot. A lot of you just asked me about this. There's a helicopter back there that I flew in the Marine Corps for a number of years and deployed to Iraq 3 times. And there is instruments in this helicopter, and you use them in dusty or when you're flying on, in the clouds, whatnot. And you have to trust your instruments and not fly by what you feel, because you'll throw yourself for you'll get vertigo and spatial disorientation. And right now, a lot of people have vertigo and spatial disorientation to this market because there's a belief that it isn't that bad. There is a belief that these are good companies. There's a belief XYZ, fill it in there. And there's a belief that you're going to miss the move higher if you're not there watching and hawking the charts every day. And I'm telling you that this move here, you didn't miss anything, and we're on a weekly chart. So I'm hoping that gives you a little comfort. And look, if you want to talk, call 855-732-5932. We always pick up our own phones, okay? And so with that, I hope you have a great night. I really love you, stock nerds. This was a long video. I'm sorry about that, but I really, really, really hope it helped, okay? And I'll see you Friday with the podcast with Don, Dandy, and Hunter. And with that, I'll see you with the next update.